Now let's go to the 90-minute cycle times. Okay, so here we go. Here you got the 90-minute cycle times. I personally use 2:30 EN EST to 4 EM. These are the 3 London tile 90-minute cycles. 4 EM to 5:30 EM, 5:30 EM to 7 EM. 7 EM, which is the pre-New York open. Okay, pre-New York session is basically the New York opening price. So then we have New York 7 EM to 8:30 EM, 8:30 EM to 10 EM, 10 EM to 11:30 EM. So these are the 3 for London, and these are the 3 for New York. Now I want you to understand how to trade it. Okay, how can we trade those 90-minute cycles? Now we have to understand the logic of the CLS delivery, how the CLS delivers the price. Okay, so the CLS delivers price from 2 EN EST and finds counterparty for all that have been placed within every hourly interval. So you should focus on taking your trades inside the start of a new hourly candle. We allow price to form time-based structure for the first 30 minutes. Okay, the first 30 minutes. This will give you all the information you need to make a buy or sell. So basically, imagine there is the 90-minute cycle, the second 90-minute cycle of New York. Okay, which is from 4 in the morning to 5:30 in the morning. So what we do is we allow those first 30 minutes to give us information to, you know, like to create a structure to do anything price need to do, and from there, after those 30 minutes, we can say like, okay, I'm gonna place a buy, I'm gonna place a sell, I'm gonna place a trade. But we allow the first 30 minutes to do something, because the really, listen to this, the really draw on liquidity is 60 minutes. The really 90-minute cycle is 60 minutes. Okay, no 90 minutes. The first 30 minutes is to create a structure, is to manipulate. Okay, and then the next 60 minutes we use the next 60 minutes to for the draw on liquidity and for distribute the orders. So that's why we allow the first 30 minutes of every hourly interval candle. Okay, of every hourly candle. So imagine the 90-minute cycle, the second 90-minute cycle starts at 4 in the morning. We wait for 4:30. Okay, sometimes if the trade is too obvious, because the CLS is not always going to be perfect, so if the CLS, if the structure tells you to buy or sell at 4, that's okay, you can place a sell, a buy. I've done that before, but it's always better if we wait for the 30 minutes to have information of what price is doing and what price is gonna do. So as we know that's why the real 90-minute cycle starts at 2:30 and not 2, because the CLS starts the delivery at 2 EM in London session at 2 EM, but we use the first 30 minutes, and from there the 90-minute cycle starts. The real 90-minute cycle starts at 2:30. So yeah, like I say, 2:30 to 4, that's the first 90-minute cycle. Now, how do we trade the first 90-minute cycle of 2:30 to 4? Remember what I told you in the last chapter. I was telling you about in the CLS intervals of London. I was telling you that between 2 to 3 there is the initial distribution of liquidity. Okay, the initial distribution of liquidity starts at 2 and ends at 3. So there is a way to trade this first 90-minute cycle from 2:30 to 4. What I basically do is I use the first 90-minute cycle as information, because what they gonna do on these first 90-minute cycles is to move the price to those certain liquidity pools to take liquidity. Imagine Asia high, Asia low, or if there is a big fair value gap, a big order block. What they gonna do between 2:30 to 4, they're gonna move the price to those certain liquidity pools, and then is when the second liquidity cycle comes. So imagine it's simple as between 2:30 to 4, they move the price taking Asia high to a fair value gap, to a order block, to anything, and then with that information we start trading starting from 4 EM to 5:13 EM, which is the second liquidity cycle. As I told you in the last chapter, what happens between 4 to 6? Yeah, what happens between 4 to 6 is the distribution on European pairs. The big move, I call it the big move. Okay, 90% of my London trades are between these two times, between 4 to 5:30. Let's say 6. Okay, yeah, we know that the CLS distributes the liquidity every 90 minutes. That's why we put 5:30, but we can use 5:30, 5:06. We should start to take partials or to track the whole trade at 5:30. Okay, because most of the time the draw on liquidity will be at this time, at 5:30 London, on the London session East time. So now look at this. Okay, we go here, the 2 yen here, 3 yen here. Okay, that's the time interval when price is moving to take those certain liquidity pool, to take those highs, those lows, to move to those other blocks, to those fair value gaps. So we can see between 2 to 3 how price takes Asia high, and then what price does is displacement, taking this low, and then you can start placing a sell here. Okay, if you play with the times, you're gonna find a fair value gap, a order block, or a BPR, anything here. You're gonna find anything good to trade here at 4. So 4 starts the first 90-minute cycle, so we can start selling here, or we can wait, as I told you before, for the first 30-minute cycles. Okay, sorry, the first 30 minutes. We wait for the first 30 minutes to give us information to be more sure about the trade, if it is gonna play or not. So imagine here we got the 4 time with the 4 here. We wait for price to give us information, because we don't know if price is gonna go this up or it's just gonna keep selling from where it is. So we just wait until 4:30. We can see how then price breaks this low, break this low here, this low, and then come back to this order block, which if we go to this 1 minute time frame, we're gonna find a fair value gap here, or what we got this order block. And what time is it? 4:30. So at 4:30 you can place a safely sell here. Imagine you place the sell here with a stop loss above the high, or above this one. Let's say above this one, above the high, meaning what? Those lows here, those lows there. So of course it wasn't perfect, but this is the Asia low. It was taken after, we can see there, it was taken after. But I just want you to show you that, look how at 4 EM after price use talks those highs between 2 to 3, let's say between 2 to 3, the CLS made the delivery. So those orders are already closed. Okay, Now what the new orders are going to do, what CLS is going to do is, I mean those lows are going to take the sell side liquidity here, because the buy side was already taken, and as the buy side was already taken between 2 to 3, the liquidity was already taken between 2 to 3. What they're gonna do now is between the next cycle, between 4 to 6, they're gonna distribute price on those European pairs. This is USD, and there's gonna happen the big move I'm showing you now. Of course, price after that, price came back to the entry. They may be opening new orders here to distribute all those orders, and after that price just takes everything. And yeah, this is basically an example of about how you can trade those 90-minute cycles. I'm gonna now explain you another one. So just look at this, another example. So we have 230 here. Okay, 230 is here. So we don't trade the 230 to 4. What we do is we allow this 90-minute cycle to take those liquidity pools, to distribute price, to basically take those high, those low, those liquidity pools, or tap into the fair value gap or the block, etc. So what we got here, this is a previous day low here. We got this here. This is a previous day low we got. So look how the first 90-minute cycles went straight to take that liquidity, and after that what we got the last sweep. Look how here it wasn't 4 yet here or here, T30, so it 4 here, but now look at this, 4, we saw the sweep. If when you have experience with the 90-minute cycle, you can easily place a buy here at 4, but look how you can just wait for a beta confirmation. Look, this price breaking this short-term high breaking, and then here it comes 430, 440. Here you go, you buy order flow. Here you have your buy, is here. You can place a buy there based on the 90-minute cycle, the second 90-minute cycle of New York, which is the most I use. Imagine you put your stop loss below this low, because all of this is mitigated. So if price goes this low, you won't be interested anymore. You put your stop loss there, and when you're taking partial, you can take partial here at this high, and you can finally take in partials where between 530 to 6. So 530 is here, and imagine that you start seeing how price was going down at 530, and you just close your position here. It is easy, a 1-3 risk reward trade, risking 1%, gaining 3%. So the first 90-minute cycle, we don't trade. We wait first for liquidity to be taken, and then the second one, which is the big move, we trade like that. We trade like this. Okay, 4 to 530. You wait the first 30 minutes to give you information, and there we go. 430, you entry. There you go. We close this fair value gap, this gap here, all of this that is unmitigated. At 530 we close the position, and that's it. So this is another example of how you can trade the 90-minute cycle. This is all about context, okay? And it's not like on Monday this is gonna happen, on Tuesday this is gonna happen, on Thursday this is gonna happen. No, it's not like that. And because, how can I tell you this? The CLS reset themselves every day. So every day they having new orders. So it's not like, okay, on Monday this is gonna happen and Tuesday is gonna happen. No, you need to have a context. Okay, every day we trade the 90-minute cycle with the context of that day, not because of the day before. Okay, the 90-minute cycle is for intraday. If you want to trade with the bias and with all the stuff, yeah, you trade your bias, you have your bias, but the 90-minute cycle is for trading with intraday bias. Okay, we are intraday context, because the CLS is reset every day. So every day the new orders come into the CLS and they figure out what they're gonna do with that. So now look at this. This is another example. This is a trade I posted time before, I don't know, yeah, this was around 25 of October. I post this trade on my Telegram group. I will see if I can find the trade. But yeah, try to use the 90-minute cycles with context, because the same thing is not gonna happen every day. Okay, so you need a context for this. We have the most important thing, which is the time. So we know the 90-minute cycle, the second cycle of New York, which is the one we should use more, is the 8:30, the 90-minute cycle from 8:30. So look at this. We got buy side liquidity. Okay, with buy side liquidity here. As we know, we got buy side liquidity there, and we use the 90-minute cycle of the 8:30 because of the news are coming. What can we expect? We got this point here, the fair value gap with all the block. Let's say the 3-minute fair value gap. Now look, price took all this liquidity, tapping in that fair value gap. Now when you see that, you can, okay, this is only 7, so I'm not yet placing any trades, because you should start trading New York from 8:30. Now you just wait for a confirmation, then we go 8 here, and like I always tell you, like I told you before, you wait for the first 30 minutes. Okay, for the first 30 minutes of the hourly candle to give you information. So look at the information this gives. It's 8 here, this come down to this type of order block here, which was the one that took all that liquidity. You got that order block, you got price tapping in there, and from there you can, okay, this is already 8:20, 8:30. Then look how price take this high, come back to this fair value gap, order block, fair value gap. What time? 8:30, 8:40, and then you already have your information. Okay, you know that this 90-minute cycle is starting from 8:30 you can use put a stop loss below those lows and your TP below those highs. Why? Because we wait the 30 minutes. Listen, we wait those 30 minutes to give us information when the 90-minute cycle starts at example 4. Okay, this is the start of the hourly candle, so we wait 30 minutes, or imagine 2, we wait 30 minutes. But as it is 4:30, we don't have to wait 30 minutes, because this is already 8:30. They are the 30 minutes after the hourly candle was formed. We go already the 30 minutes, so we can at 8:30 place a buy. So this is how you can trade the 90-minute cycle. This is more logic. There is no like a secret behind it, because if not, I would be a fucking multi-millionaire. Everyone that know the fucking times, they would be millionaires. But it is not like that. We need context. Okay, we need context. We need, imagine buy side liquidity, fair value gap here. We got the sell side liquidity taken, tapping in the fair value gap. We wait for the 30-minute, 90-minute cycle, 8:30, we place a buy. Short and high taken, come back to the fair value gap, we place a buy. That's how we trade those 90-minute cycles with a context. There is no a secret behind, okay? We should have context, okay?